Researchers looked at the best days in the stock market over a 30-year period. They identified the 10 best days. And then they calculated what would have happened if you had missed those 10 days. Just 10 days out of more than 7,000 trading days. If you had been in the market every single day except those 10 best days, your returns would have been cut in half. Cut in half by missing just 10 days. I need to tell you something that might be hard to hear. If you have been trying to time the stock market, trying to figure out when to buy and when to sell, trying to avoid the crashes and catch the rallies, you are making the single most expensive mistake in all of investing. This mistake has destroyed more wealth than perhaps anything else in the history of the stock market. And today, I am going to show you exactly why market timing does not work, why even the professionals cannot do it, and most importantly, what you should do instead. So let us get started. Well, hello there. I am glad you have decided to spend some time with me today. You know, over the years, I have been asked thousands of questions about investing. Questions about which stocks to buy, when to sell, what sectors look promising. But there is one question that comes up more than almost any other, and it usually sounds something like this. When should I get out of the market? Or is now a good time to buy? Or should I wait for the crash? And every single time I hear that question, I feel a little bit sad. Not because it is a bad question to ask. No, it is a perfectly natural question. The problem is what that question reveals. It reveals that the person asking it believes something that simply is not true. They believe they can time the market. They believe that they, or someone they are listening to, can figure out when to be in and when to be out. And I am here to tell you, as plainly as I know how, that this belief has destroyed more wealth than perhaps any other mistake in the history of investing. Now, I do not say that lightly. I have been doing this for a long time. I have watched market cycles come and go. I have seen bubbles inflate and pop. I have watched investors make the same mistakes over and over and over again, generation after generation. And the single biggest mistake, the one that causes the most pain, the most regret, and the most permanent loss of wealth, is the attempt to time the market. So today, I want to talk to you about this. I want to explain why market timing does not work. I want to show you the math behind why it fails. I want to tell you some stories from history that illustrate just how dangerous this game really is. And most importantly, I want to give you a better way, a way that actually works, a way that has worked for me and for every successful long-term investor I have ever known. But first, let me be clear about what I mean by market timing. I am talking about the practice of trying to predict the future direction of the stock market so that you can buy before it goes up and sell before it goes down. I am talking about people who move in and out of stocks, in and out of the market, based on their predictions or feelings or what some expert on television told them. I am talking about the belief that you can outsmart millions of other investors and somehow know what is coming next. Now, does that sound appealing? Of course it does. Who would not want to buy low and sell high? Who would not want to avoid the pain of a market crash? Who would not want to capture all the gains and none of the losses? It sounds wonderful. It sounds logical. It sounds like the smart thing to do. There is just one problem. It does not work. Let me say that again, because this is important. Market timing does not work. It does not work for professionals. It does not work for amateurs. It does not work consistently for anyone over any meaningful period of time. And the reason it does not work is not because people are not smart enough, or do not have enough information, or do not try hard enough. The reason it does not work is because it is impossible. You see, to successfully time the market, you need to be right twice. You need to know when to get out, and you need to know when to get back in. And you need to be right about both of those decisions consistently, over and over again, for years and decades. Miss either one of those calls, and you have failed. Get out too early, and you miss gains. Get out too late, and you suffer losses. Get back in too early, and you lose more. Get back in too late, and you miss the recovery. The math is brutally unforgiving. Let me give you some numbers, because I am a numbers person, and numbers do not lie. There have been numerous studies done on this topic over the years, and they all come to the same conclusion. The average investor, the person who tries to time the market, who moves money in and out based on feelings or predictions or news headlines, that person dramatically underperforms the market itself. How much do they underperform? Well, one of the most comprehensive studies looked at investor returns over a 20-year period and compared them to the returns of the stock market itself. And what they found was shocking, though not surprising to me. The average equity investor earned about 4% per year, while the stock market itself, the simple index, returned about 9% per year. Now, you might be thinking, well, that is not so bad. 4% is still positive. But let me show you what that difference really means. If you invested $10,000 and earned 9% per year for 20 years, you would end up with about $56,000. Not bad. But if you earned only 4% per year, you would end up with about $22,000. You would have less than half the money. You would have given up $34,000 just by trying to be clever, just by trying to time your moves in and out. That is the cost of market timing. That is what it really does to your wealth. And here is the thing that really troubles me. That 4% return is actually worse than it appears, because during that same period, bonds returned about 6% per year. So the average investor, trying to be smart about stocks, trying to time the market, actually would have been better off just buying bonds and going to sleep for 20 years. Think about that. All that effort, all that stress, all that watching and worrying and reading and predicting, and they would have been better off doing nothing at all. Now, why does this happen? Why do people perform so poorly when they try to time the market? The answer is human nature. It is psychology. It is emotion. You see, when the market is going up, people feel good. They feel smart. They feel confident. And so they want to buy more. They want to be in the market. The higher it goes, the better they feel, and the more they want to own. And then, inevitably, the market turns. It always does. And when it starts going down, those good feelings turn to bad feelings. Confidence turns to fear. Optimism turns to panic. And people want to sell. They want to get out. They want to protect what they have left. The further it falls, the worse they feel, and the more they want to sell. Do you see the pattern here? People buy when prices are high, and everyone is excited. They sell when prices are low, and everyone is scared. They do the exact opposite of what they should do. They buy high and sell low, over and over and over again. And then they wonder why they are not making any money. I call this the rear view mirror approach to investing. People look at what just happened and assume it will continue. The market went up last year, so they think it will go up this year. The market went down last month, so they think it will go down next month. They are always looking backward and making decisions based on the past, and by the time they act, the moment has already passed them by. Let me tell you about a study that really drives this point home. Researchers looked at the best days in the stock market over a 30-year period. They identified the 10 best days, the days when the market went up the most, and then they calculated what would have happened if you had missed those 10 days. Just 10 days out of more than 7,000 trading days. If you had been in the market every single day except those 10 best days, your returns would have been cut in half. Cut in half by missing just 10 days. Now, here is the problem. When do you think those best days occurred? Were they on sunny days when everything was going well and everyone was feeling optimistic? No. Most of those best days occurred right in the middle of the worst crashes and bear markets. They occurred when things looked terrible, when everyone was scared, when the headlines were screaming about recession and disaster and the end of the world as we know it. If you were out of the market because you were trying to avoid the bad days, you would have missed the best days too. And if you missed the best days, your returns would have been destroyed. That is the trap of market timing. You cannot have one without the other. Now, let me take you back in time a bit, because I think history is one of the greatest teachers we have. And when it comes to market timing, history has some very clear lessons for us. Let us go back to October of 1987. Some of you might remember this. It was a Monday, October 19th to be exact. The stock market crashed. And I do not mean it went down a little bit. I mean it crashed. The Dow Jones fell 22% in a single day. 22%. It was the largest one-day percentage drop in history. Larger than anything that happened in 1929. Larger than anything we have seen since. Now, imagine you were an investor on that day. Imagine watching your portfolio lose more than a fifth of its value in just a few hours. The fear must have been overwhelming. The temptation to sell, to get out, to protect what you had left, must have been almost irresistible. And many people did sell. They got out. They said, this is it. This is the big one. The whole system is collapsing. I need to get to safety. And you know what happened next? The market recovered. Not in years, not in months. Within 2 years, the market was back to where it had been before the crash, and then it kept going up. If you had sold on that terrible Monday or in the weeks after and waited for things to settle down or look better, you would have missed one of the greatest bull markets in history. The market went on to more than triple over the next decade. The people who sold, who tried to time their exit, they lost. The people who stayed in, who held on through the fear and the panic, they won. Or let us talk about a more recent example. The year 2008 and 2009, the financial crisis. I remember it well. Banks were failing. Lehman Brothers collapsed. The government was bailing out major institutions. The headlines were apocalyptic. People were talking about another Great Depression, and the market fell. It fell and fell and fell. From its peak in 2007 to its bottom in March of 2009, the market lost about 57% of its value. More than half. Gone. Now, at the bottom in March of 2009, how did things look? They looked terrible. Unemployment was soaring. Companies were going bankrupt. The economy was in free fall. Every expert on television had a new reason why things were going to get worse. And many investors, maybe even most investors, were absolutely convinced that the smart thing to do was to get out, to go to cash, to wait for the storm to pass. I have to ask you, do you know what happened to the market after that low point in March of 2009? It went up. It went up a lot. In fact, from that bottom to the end of that same year, the market rose more than 65%. 65% in about 9 months. If you had sold at the bottom, if you had waited for things to look better before getting back in, you would have missed the entire recovery. And not just the recovery. From that low point in 2009 to the end of 2019, before the pandemic, the market went up more than 400%. 400%. And the people who missed it, who were sitting in cash waiting for the right time to get back in, they missed it. They missed one of the greatest wealth-building opportunities of their lifetimes because they thought they could time the market. Do you see the pattern here? The best time to buy is when things look the worst. The worst time to sell is when you are most scared. But that is exactly backwards from what our emotions tell us to do. Our emotions tell us to sell when we are scared and buy when we feel confident. And following those emotions is a recipe for disaster. Let me give you one more example, and this one goes way back. In the 1920s, there was a new technology that everyone was excited about. It was called radio. And just like the internet in the 1990s, or cryptocurrencies more recently, people thought radio was going to change everything. And it did change a lot. But people got carried away. They bid up radio stocks to absurd levels. Everyone wanted to own them. Everyone was afraid of missing out. And then, in 1929, the bubble burst. The market crashed. Radio stocks, along with everything else, collapsed. And people who had tried to time their exit, who had held on too long, hoping for just a bit more gain, they lost fortunes. But here is the interesting part. Some of the radio companies that survived went on to become enormously successful. RCA, for example, became one of the great American companies. If you had bought it at a reasonable price and held it for decades, you would have done extraordinarily well. But if you tried to trade it, tried to catch the highs and avoid the lows, you almost certainly would have lost money. The lesson is always the same. Time in the market beats timing the market. Every single time. Now, you might be thinking, well, maybe I cannot time the market, but surely the professionals can. Surely the people who do this for a living, who have all the research and all the computers and all the fancy models, surely they can do it. And I understand why you would think that. It sounds reasonable, but I have some bad news for you. The professionals cannot do it either. Let me tell you about something called mutual fund performance. There are thousands of mutual funds out there, managed by very smart people with very impressive degrees from very prestigious schools. These people spend all day, every day, trying to beat the market. They have teams of analysts, they have access to company management, they have sophisticated computer models, they have everything you could possibly want if you were trying to time the market or pick the best stocks. And you know what the data shows? The vast majority of them fail. Study after study has shown that somewhere between 80 and 90% of actively managed mutual funds fail to beat a simple index fund over any meaningful time period. 80 to 90%. These are professionals, remember, people who are paid millions of dollars to do this. And they cannot do it. Why not? Because beating the market consistently requires you to know something that everyone else does not know, or to see something that everyone else does not see. And in a world where information travels at the speed of light, where millions of people are analyzing the same data, where computers are processing billions of transactions per second, that is extraordinarily difficult, maybe impossible. I know some of the smartest investors in the world. I have spent time with them. I have learned from them. And not one of them, not a single one, has ever told me they can consistently predict what the market's going to do next week or next month or next year. Oh, they might have opinions. They might have hunches. But they do not bet the farm on those hunches because they know better. Let me tell you a little story about my friend and partner, Charlie. Charlie is one of the wisest investors I've ever known. And years ago, someone asked him about market timing. They wanted to know his secret. And Charlie said something I have never forgotten. He said, "We have never made a dime by predicting the economy or the stock market. All of our success has come from buying good businesses at reasonable prices and holding them." That is it. That is the secret. Not timing, not predicting, just buying good things when they are reasonably priced and having the patience to hold them. But I know what some of you are thinking. You are thinking, but surely there are some people who have done it. Surely there are some famous investors who have successfully timed the market. And yes, there are people who got out before a crash or got in right before a rally. But here is what you need to understand. If you have enough people making predictions, some of them are going to be right just by pure chance, just by luck. Imagine I get 10,000 people together in a room, and I ask them all to flip a coin. Heads or tails? About 5,000 will get it right. I ask those 5,000 to flip again. About 2,500 will get it right twice in a row. I keep doing this, and eventually I will have one person who has flipped heads 10 times in a row. Now, is that person a genius? Do they have some special coin flipping ability? Of course not. They just got lucky. The same thing happens in the investing world. With millions of investors making predictions every day, some of them are going to get it right a few times in a row. And when they do, they become famous. They write books. They go on television. They start hedge funds. And everyone thinks they have discovered the secret. But then, inevitably, their luck runs out. The predictions stop working, and they fade away to be replaced by the next lucky person. I have seen this pattern repeat itself over and over again throughout my career. Someone makes a few good calls. Everyone starts following them. Everyone thinks they have found the guru who can tell them when to buy and when to sell. And then it falls apart because it was never skill in the first place. It was just luck. Now, I am not saying that all investment skill is luck. Not at all. There is real skill in analyzing businesses. There is real skill in understanding competitive advantages in management quality and financial statements. There is real skill in valuing companies. But there is no skill, or at least no consistently reliable skill, in predicting what the overall market is going to do next month or next year. Those are two completely different things, and confusing them is a very expensive mistake. Let me talk to you about something that does not get discussed enough when people talk about market timing, and that is the real cost of being wrong. Not just the financial cost, though that is bad enough, but the opportunity cost, the cost of what you miss out on while you are sitting on the sidelines waiting for the perfect moment. You see, when you get out of the market, you are making an active decision. You are saying, I think the market's going to go down, so I am going to sell and hold cash. And maybe you are right. Maybe the market does go down. But then what? Now you have to make another decision. You have to decide when to get back in. And this is where it gets really tricky. Because here is what usually happens. The market goes down, just like you thought it would, and you feel smart, you feel vindicated, you avoided some losses, but then the market keeps going down. And you think, well, I will wait until it hits bottom. But how do you know when the bottom is? You do not. Nobody does. The bottom only becomes clear in hindsight months or years later. So you wait, and the market goes down more, and you wait some more. And then one day, the market starts to go back up. But you do not notice it first, because you are still focused on all the negative news. You are still hearing about all the problems in the economy. You are still reading articles about why things are going to get worse. So you keep waiting, and the market goes up more, and you start to feel uncomfortable. You start to wonder if maybe you should get back in. But it has already gone up 10%, 15%, 20% from the bottom, and you think, well, I missed it. I will wait for the next pullback. But the pullback does not come, or when it does come, it only retraces a small portion of the gains, and then the market keeps going up, and now you are really stuck. You got out to avoid losses, but you also missed the gains, and you do not know what to do. This is the psychological torture of market timing. It is not just about being right or wrong. It is about the constant second guessing, the constant wondering if you should be in or out, the constant fear that you are missing something. I have seen this destroy people emotionally. I have seen investors who were so traumatized by a market crash that they stayed in cash for years, sometimes decades. They missed out on enormous gains because they were waiting for conditions to be perfect. And conditions are never perfect. There is always something to worry about. There is always a reason to wait. Let me introduce you to a concept that my teacher Ben Graham taught me many years ago. He called it Mr. Market. Imagine that you own a share of a business, and every day Mr. Market shows up at your door and offers to buy your share or sell you more shares. Some days, Mr. Market is very optimistic. He is in a great mood. He offers you a high price. Other days, Mr. Market is depressed. He is worried about everything. He offers you a low price. Now, the important thing to understand is that Mr. Market is insane. He is manic depressive. His moods swing wildly from day to day for no good reason. The value of the business has not changed. The fundamentals have not changed. Only Mr. Market's mood has changed. So what should you do? Should you let Mr. Market dictate your behavior? Should you sell when he is depressed because you think he knows something you do not? Should you buy when he is euphoric because you think the good times will last forever? Of course not. That would be crazy. You would be letting an insane person tell you what to do. But that is exactly what market timers do. They watch Mr. Market's mood swings and they try to predict his next mood. They try to sell when he is about to get depressed and buy when he is about to get euphoric. And they fail because Mr. Market is unpredictable. His moods are random. You cannot outsmart a lunatic. The smart approach is to ignore Mr. Market most of the time. Only pay attention to him when he offers you a price that is clearly ridiculous. When he is very depressed and offering to sell you shares of a good business at a very low price, you should buy. When he is manic and offering to buy your shares at a very high price, you should consider selling. But most of the time, you should just ignore him. Let him ramble. Let him make his crazy offers. You focus on the business, not on his mood swings. This is the fundamental difference between investing and speculating. Investing is about owning good businesses and letting them compound over time. Speculating is about trying to predict Mr. Market's next move. One of those approaches works. The other does not. Now, if market timing is so clearly a losing strategy, if the evidence is so overwhelming, if even the professionals cannot do it, then why do people keep trying? Why does every generation of investors have to learn this lesson the hard way? I have spent a lot of time thinking about this question, and I think I have some answers. The first reason is that it feels like it should work. It feels like common sense. If you know a storm is coming, you go inside. If you know the market is going to crash, you should get out. It is logical. It is intuitive. The problem is that investing is one of those areas where intuition leads you astray. What feels right is often exactly wrong. The second reason is that the financial industry has a vested interest in convincing you that market timing is possible. Think about it. If I am running a mutual fund or an advisory service, and I tell you, just buy an index fund and hold it forever, well, you do not need me, do you? You do not need to pay me a fee. You do not need my advice. You can do that yourself for almost nothing. But if I tell you the market is going to crash, so you need to get out now, and I will tell you when to get back in, suddenly I am valuable. Suddenly you need me. Suddenly you are willing to pay me to manage your money. And so there is an entire industry built around the idea that someone, somewhere, can tell you what the market is going to do next. Even though the evidence says they cannot. I see advertisements all the time. Get our market timing newsletter. Our proprietary algorithm tells you when to buy and sell. We call the last 3 crashes. It is all nonsense. But it is profitable nonsense for the people selling it, even if it is expensive nonsense for the people buying it. The third reason, and this is a big one, is that we remember the hits and forget the misses. If someone tells you the market is going to crash, and it does, you remember that. You think, wow, they were right, they must know something, but you forget all the times they said the market was going to crash and it did not. You forget all the times they said to get out and the market went up 20%. We have selective memory. We remember the dramatic predictions that came true and forget the boring predictions that did not. There is actually a name for this. It is called survivorship bias. We only see the winners. We only hear about the people who got it right, the people who got it wrong, who lost money, who quit investing in embarrassment. They disappear. They do not write books. They do not go on television. They fade into the background. And so we are left with a distorted picture of reality. We see only the successful market timers, not realizing that they are successful because of luck, not skill, and that their success will not last. The fourth reason is fear. People are more afraid of losses than they are motivated by gains. This is just human nature. Losing $100 hurts more than gaining $100. Feels good. And so when the market starts to go down, the fear becomes overwhelming. People cannot stand to watch their account balance shrink. They feel like they have to do something. They have to act. Sitting still feels irresponsible. And so they sell, not because it is the smart thing to do, but because it makes them feel better in the short term. But here is the thing about fear. It is a terrible investment advisor. When you are afraid, you make bad decisions. You sell at the worst possible time. You pay too much attention to short-term noise and not enough attention to long-term fundamentals. You let your emotions override your logic, and you lose money. I learned a long time ago that the best investors are not the smartest people. They are not the people with the highest IQ or the fanciest education. The best investors are the people who can control their emotions, the people who can stay calm when everyone else is panicking, the people who can be greedy when others are fearful and fearful when others are greedy, as I like to say. That is not a market timing strategy, by the way. That is a value strategy. It means you buy when good businesses are on sale because everyone else is scared. And you are cautious when everyone else is buying everything at any price because they are caught up in euphoria. It is about price versus value, not about predicting what the market will do tomorrow. And that brings me to the fifth and final reason people keep trying to time the market. They confuse activity with accomplishment. They think that if they are not doing something, if they are not trading, if they are not making moves, then they are not really investing. But the opposite is true. The best investors I know do very little. They make a few good decisions and then they wait. They let time and compound interest do the heavy lifting. There is no correlation between activity and results in investing. In fact, there is often an inverse correlation. The more you trade, the worse you do. The more you try to be clever, the more you hurt yourself. Sometimes the hardest thing to do is nothing, but it is often the smartest thing to do. So if market timing does not work, what should you do instead? That is the natural question, and I am glad you are asking it. Because while I have spent a lot of time telling you what not to do, I want to make sure you understand what you should do. And the answer is actually quite simple, even if it is not easy. You should buy good businesses at reasonable prices, and then you should hold them. That is it. That is the whole strategy. It is not complicated. It is not exciting. It does not require you to watch the news every day or check your portfolio every hour. But it works. It has worked for me. It has worked for every successful long-term investor I have ever known. Now, what do I mean by a good business? I mean a business that has a durable competitive advantage. A business that does something better than anyone else, or cheaper than anyone else, or in a way that is hard to replicate. I mean a business with strong economics, good returns on capital, the ability to reinvest earnings at attractive rates, a business that you can understand, that operates within your circle of competence. And what do I mean by reasonable price? I mean a price where you are getting more value than you are paying for, a price where you have a margin of safety. a price where even if some things go wrong, even if the business does not perform as well as you hoped, you are still likely to do okay. This is not about buying at the absolute lowest price. It is not about trying to catch the exact bottom. It is about buying when the price is attractive relative to the value. And here is a secret. Good businesses at reasonable prices show up all the time. You do not have to wait for a crash. You do not have to time anything. You just have to be patient and disciplined and ready to act when the opportunity presents itself. Let me give you an example from my own experience. In the early 1970s, the market was not doing well. There was inflation, there was an oil crisis, there was political turmoil. A lot of people were scared. And because people were scared, stock prices were depressed. Good businesses were selling at low prices. I found a company called the Washington Post. It was a good business. It had a strong newspaper. It had television stations. It had a durable competitive advantage in its markets. And the entire company was trading for about $80 million. Now, I estimated that if you wanted to sell that company to a private buyer, someone would easily pay $400 million for it, maybe more. So here was a business worth at least $400 million, probably more, and you could buy the whole thing for $80 million. That is a margin of safety. That is value. I bought as much as I could, and I held it. I did not try to trade it. I did not try to time when to sell and when to buy back. I just held it. And over the next few decades, that investment made me and my shareholders an enormous amount of money. Not because I was smart enough to time the market, not because I predicted what the economy would do, but because I bought a good business at a great price and I had the patience to hold it. That is the approach that works. And you can do the same thing. You do not need to be a genius. You do not need to predict the future. You just need to understand what you are buying, pay a reasonable price for it, and have the patience to let it compound. Now, some of you might be thinking, but what about diversification? Should I not spread my money around? And yes, diversification is important, especially if you are not an expert at analyzing businesses. If you are not sure how to evaluate a company, if you do not have the time or the inclination to really dig into financial statements and competitive dynamics, then you should own a broad index fund. An S&P 500 index fund, for example. This gives you exposure to 500 of the largest companies in America. You own a piece of the entire economy, and you do not have to worry about picking the right stocks or timing the market. You just buy and hold, add money regularly, reinvest the dividends, and let compound interest work its magic over decades. I have said this many times, and I will say it again. For most people, a low-cost index fund is the best investment they will ever make. It is simple, it is cheap, and it works. You will beat the vast majority of professional investors over time simply by doing nothing, simply by being patient, simply by refusing to play the market timing game. And here is the beautiful thing about this approach. It removes all the stress and anxiety from investing. You do not have to watch the market every day. You do not have to worry about whether now is a good time to buy or sell. You do not have to listen to the experts on television telling you what to do. You just invest regularly, hold for the long term, and get on with your life. Is that boring? Yes. Is it unglamorous? Absolutely. Will it make you rich overnight? No. But will it build substantial wealth over time? Yes. Will it give you financial security? Yes. Will it allow you to sleep well at night? Yes. And is that not what you really want? Is that not the point of investing in the first place? So let me bring this all together for you, because I want to make sure you walk away from this conversation with a clear understanding of what I am trying to tell you. Market timing does not work. It does not work for professionals. It does not work for amateurs. It has never worked consistently for anyone over any meaningful period of time. The people who claim they can do it are either lying or lucky, or they have not been doing it long enough for their luck to run out. The costs of trying to time the market are enormous. You pay costs in fees and taxes every time you trade. You pay costs in missed opportunities when you are sitting in cash. And you pay costs in stress and anxiety and lost sleep. It is a game that is rigged against you from the start. But the good news, the wonderful news, is that you do not have to play that game. There is a better way, a simpler way, a way that actually works. Buy good businesses at reasonable prices, or buy a low-cost index fund and hold for the long term. Be patient, be disciplined, ignore the noise, ignore Mr. Market and his mood swings. Focus on what matters. Focus on the fundamentals. Focus on value. And understand this, the stock market is not a casino. It is not a place to gamble or speculate or try to get rich quick. It is a mechanism for owning pieces of real businesses, businesses that make products, businesses that provide services, businesses that employ people and serve customers and create value. When you own stocks, you own a piece of those businesses. And if those businesses do well over time, you will do well over time. It is that simple. Now, will there be bumps along the way? Of course. Will the market go down sometimes? Absolutely. Will there be crashes and bear markets and times when it feels like the world is falling apart? Yes. That is part of the deal. That is the price you pay for the extraordinary long-term returns that stocks provide. But if you can stay calm during those times, if you can resist the urge to panic and sell, if you can even see those times as opportunities to buy more at lower prices, then you will be fine, more than fine. You will build real wealth. I have been investing for more than 7 decades now. I've seen a lot of things. I've seen wars and recessions and crises of every kind. I have seen the market crash more times than I can count. And every single time, people said it was different. They said this time it would not recover. They said the system was broken. They said it was the end. And every single time, they were wrong. The market recovered. The economy recovered. The businesses adapted and survived and thrived. And the people who stayed invested, who refused to panic, who kept their focus on the long term, they were rewarded. So my warning to you today is simple. Stop trying to time the market. Stop listening to the people who claim they can tell you when to buy and when to sell. Stop checking your portfolio every day and making decisions based on short-term movements that mean nothing. Stop letting fear and greed dictate your actions. Instead, make a plan, a long-term plan based on sound principles. Buy quality, pay reasonable prices, diversify appropriately, and then have the courage and the patience to stick with that plan through good times and bad. Do that, and I promise you, you will look back decades from now with no regrets. You will have built wealth, you will have achieved financial security, and you will have done it without all the stress and anxiety and second guessing that comes with trying to time the market. The choice is yours. You can keep playing a game you cannot win, or you can adopt a strategy that has been proven to work over and over again throughout history. I know which one I would choose. I know which one I have chosen, and I hope after spending this time with me today, you will make the right choice too. Thank you for listening. I wish you all the best on your investing journey. And remember, time in the market beats timing the market every single time.